I think a lot of people have been wondering what the renewal wall will actually look like as we get past it. And the most recent mortgage industry report from CMHC answers that question pretty well. It tells me why Canada's big banks are so upbeat about mortgage renewals right now. Basically, your borrowers are stuck with them. They're trapped in this position where they can't really shop exceptionally well on a renewal. You'll hear this from mortgage brokers in the space. They're getting beat by the big six banks on renewal files. If a borrower is up for renewal and they want to shop and try and get a better rate or whatever, the qualifying criteria is so much difficult for them. Even since OSFI has removed the stress test on renewals. And so this massive wave of renewals is locking in borrowers and supercharging big six banks. In fact, Canada's renewal wall, a surge of mortgages from 2020 to 2021 that are now up for renewal. Remember, we had record buying during that period of time, has created an unexpected outcome. Borrowers are largely sticking with their current lenders, leading to renewals more than doubling year over year at major banks. Essentially, many homeowners feel trapped and have limited options, and the big six banks are crushing it by retaining these clients. At the same time, we're seeing a major pivot back to fixed rate mortgages, specifically terms between 3 and 5 years, have reclaimed the crown as Canada's most popular mortgage product. So this would tell us that borrowers think that interest rates are going to go down, but maybe they're not going to go down as quickly as they had originally thought. In the spring of this year, the variable mortgage rate was the most popular mortgage product. And it briefly took the top spot last year, and they've fallen back to second place as borrowers are seeking stability among this economic uncertainty and the fact that rates might not have as much downside as we originally thought. So in this video, I'm going to break down why big banks are winning on renewals, what the renewal wave will mean for homeowners, and why fixed rates are back in fashion. We're going to also pull up a couple of key charts from CMHC's residential mortgage industry report to visualize these trends. Let's get into it. Okay, so let's first talk about this so-called renewal wall and why it's a big boon for banks. We had an unusually high number of mortgages that originated during 2020 and 2021 during the home buying frenzy of the pandemic, when borrowers qualified at super low rates. Add to that many borrowers who chose shorter terms in 22 and 23, because during that period of time, their most popular mortgage product was the 3-year fixed. And the result is this flood of mortgages all coming up for renewal around the same time. In the last half of 2025, over 750,000 mortgages will hit renewal, and another 1.15 million in 2026, and 940,000 in 2027. This is what industry insiders and the media have dubbed the renewal wall. Now, you would think that this would spark fierce competition among lenders to poach each other's clients, right? Renewal is often a place where lenders will really try and get court deals from other lenders. But CMHC's data confirms something that industry observers have suspected for a long time. Most borrowers are staying put, renewing with their existing lender, often one of the big six banks. In fact, same lender renewals more than doubled in the first half of 2025 compared to the first half of 2024, which you can see on the chart here. In 2024, it was 50 billion. This year, it's 107 billion. This is over 100% year over year jump in renewals at the same bank, which is huge. And it's obviously putting upward pressure on the big six banks' market share, where they now have 58% market share of all originated mortgages and 75% share of all outstanding mortgages, the highest that they've had in at least the last 3 years. So why are so many borrowers renewing with the same bank? A big reason is that many feel trapped, or they literally are trapped. Remember, these mortgages were originally taken out or even refinanced at ultra low rates. For example, a 5-year fixed in mid-2020 averaged around 2.36%, whereas in mid-2025, it's roughly 3.95%. So that's a 67% jump in interest costs for the average borrower coming off a 5-year term. Faced with that payment shock, homeowners are often opting for the path of least resistance, accepting their current bank's renewal offer rather than shopping around, especially if their financial situation has changed or if it hasn't improved substantially enough for them to be able to go get another loan from another institution. Now, borrowers are worried that they won't qualify elsewhere, or they know the reality that they won't qualify elsewhere. or perhaps other lenders aren't offering significantly better rates. You have to understand that if you get a renewal, the bank is basically just sending you a letter that you can check a box that would allow you to renew your existing mortgage term with no changes, unless like something major has changed on your credit file. And I asked Ron Butler about this recently on Twitter. Like if there's major significant debts or like something registered against you where your bank would have been notified, or if there's a delinquency, like you missed a payment or something like that. But otherwise, it's as easy as like you kind of just check the box and renew your mortgage and everything's okay. And add to that the fact that rates are a lot worse now than they were when a lot of these borrowers got their mortgages for the first time. Some people might not even qualify for the mortgage at new rates, because we've actually exceeded how much the stress tested those rates, right? They were stress tested at 5.25% or 200 basis points above the contract rate. So many borrowers basically just stay with their original bank, even if it means a higher rate, because it's at least a known quantity. Now, it's worth noting that there have been some policy tweaks to encourage people to shop around because we didn't want to create this anti-competitive mortgage market. For instance, the regulators removed the stress test requirement for switching lenders at renewal for uninsured mortgages, making it easier to transfer your mortgage to a new lender without requalifying. And indeed, the data shows that more people did switch. Lender switches of uninsured mortgages jumped by 60. Competition is helping. Those who shopped around often got better rate, contributing to a 25% drop in interest rates on renewed uninsured loans, between 24 and mid-2025. However, even with that increase in switching, it's a drop in the bucket compared to the overall weight, and especially how much of an increase we've seen in renewal business. So the vast majority still renewed with the same lender, which is typical of Canadians, which for many Canadians means the big six bank. And this is interesting. Like, I don't talk much about banks and their income and the way that they do, conduct business and make money. But I'm on the Canadian Investor Podcast Network, so I'm a host of the Real Estate Show on the biggest investing podcast in Canada, and those guys talk a lot about it. And I think, to me, if I'm interested in investing in Canadian banks, this is interesting to me because a renewal is business that costs them nothing to get, right? It's just a customer that they already acquired 5 years ago, 3 years ago, whatever it was. And now that person, they're going to get that person for another 3 to 5 years, and they don't have to pay, marketing, et cetera. If anything, that borrower has been paying them for the past period of time. So your cost of customer acquisition for the banks goes way down in this type of deal. It's just interesting from my perspective. From the bank's perspective, this is about client retention on a massive scale. The big six already hold about 75% of outstanding mortgages in Canada, which I mentioned, and now they're gobbling up a big share of the renewals too. In fact, of their new mortgage originations, including renewals and refinances, the share jumped to 59% in early 2025, up from 54% the year before. Some of this was boosted by RBC's acquisition of HSBC Canada, which folded HSBC mortgages into RBC. But it also reflects that there were organic gains from this renewal wave. The bottom line here is that the renewal wall has largely benefited Canada's biggest bank as borrowers stick with them through higher rate renewals. For borrowers, being trapped isn't a great feel. It means less bargaining power, potentially higher costs, no way for you to go and negotiate or find relief from another lender. But there's a silver lining here, is that banks want to keep these customers. So we're seeing efforts to accommodate them, like extending amortizations, offering slightly discounted rates, in many ways, just kicking the can down the road of problems with this stuff. Like, the other thing is you have a lot of those extended pretend mortgages coming up for renewal. If we go back to this chart that shows the distribution of rates, like your peak variable rate was, and that's people taking variable rates, when almost 60% of mortgage borrowers are taking variable rates, happened in January of 2022. So those mortgages don't actually reset if they're on a 5-year variable term until early 2027. But they've already experienced the pain. But for the ones who are on fixed payment variable that went into negative amortization and had hit their trigger rates and whatever, those are going to be a little bit of a mess to unwind. Now, so far, CMHC observes that most borrowers are handling the payment increase. Delinquency rates remain relatively low, although there is an uptick in stress. Ontario's delinquency rate did rise this year, and you're seeing delinquency rates rising at chartered banks, where is the only place that we actually have Q2 data already, and you can see it's higher. It's kind of a horrible choice of color on that, but we'll see if I can zoom in here. Credit unions saw an uptick. Other non-bank lenders saw a big drop down in delinquencies from 2024, the end of 2024 to Q1 of this year. And your MIEs, which is mortgage investment entities, this is like your private lenders, institutional private lenders, so like MIX, they also saw a drop in their delinquency rate. So it seems to be good for the private side on the delinquency, bad for the chartered banks on the delinquency side. I think this is going to be crucial to watch how this plays out as we see even more renewals hit in 2026. Now let's shift over to the fixed versus variable rate debate. I love this chart that CMHC puts out. I always rush to post it every time it comes out because I'm always fascinated to see what rates borrowers are picking, right? What rates are most attractive to borrowers at any given time during the market. This stuff tells me what borrowers think is going to happen to rates. Like earlier this year, we saw a huge increase in borrowers taking variable rates, which tells me borrowers think rates are going to come down quickly. Before that, borrowers were taking 3-year fixed, which told me that they thought rates were going to come down, but not quickly. It was going to take a long period of time because we're in that 3-year fixed was the most popular mortgage product for basically like all of 23 and 24. And then it flipped briefly and now it's back. As this is a hot topic for anyone with a mortgage. Over the past year, we've seen a seesaw in popularity, right? And even the jockeying between the 3 and the variable is interesting to me. You know, there was even a period of time where you saw people taking 1, 2, and 3 years, so like sub 3-year mortgage rates were the most popular, and then that was replaced by your 3-year. The interesting part here is that traditionally Canadians favor 5-year terms. So what happened here? The Bank of Canada's rate hikes obviously pushed variable rates sky high in 23, and by early 2024, there was a widespread expectation that rates might start falling. So many borrowers figured, hey, if rate cuts are coming, that variable might save me money over my mortgage term. And I can always lock in at a lower fixed rate later because variables are typically open or they have a lower penalty compared to your fixed. So we had another little blip, a period where variable rates enjoyed a little run in first place. Fast forward to mid 2025 to present day, and the trend flipped again. Fixed rates, your 3 to 5 year terms, so basically your 3-year mortgages. I think there's a little bit of 4s in there. Don't know the mortgage products exceptionally well. I would just say check with Ron Butler on that stuff. But as of August 2025, about 43% of new mortgages were in that 3-year fixed category, making it the top choice, while variables fell back to second place with 26, and variables peaked at 43 as well. So what caused this swing? By mid 2025, fixed mortgage rates, especially 3 and 4-year terms, dropped below variable rates at the time of origination. The yield curve had inverted earlier, meaning longer term rates eased off, even while the Bank of Canada's overnight rate was still high and they hadn't been able to outcut the market yet. So if you walked into a bank in mid 2025, the offer for a 4-year fixed might be 5% versus a variable at 5.5%. Maybe a little bit lower. Those would be like your posted rates. And naturally, borrowers gravitate towards the lower rate. And CMHC notes that there was this lower relative interest rate on fixed loans that was the key driver for the shift. There's also a lot of uncertainty about the economy. Will there be a recession? How fast will inflation cool? In uncertain times, predictability is king. Homeowners showed they'd rather lock in a rate for a few years than risk further rate volatility while they already have volatility in jobs, house prices, asset values, etc. So they want to buy that little period of stable payment. And the CMHC report also suggests that this shift might reflect heightened economic uncertainty. So what insights can we draw from these trends? Number one, big banks have the upper hand. If you're with a major bank and your mortgage is up for renewal, be aware that the default option will favor the bank. They know many borrowers won't switch, don't want to switch. It's always worth shopping around and negotiating, talk to a mortgage broker. Even though the data shows that most people don't switch, those who did often get a better deal. And the other piece is to try and use that as leverage to negotiate with your existing lender. The competition is still out there. Credit unions and other lenders still want your business. And the stress test hurdle for switching is gone. So don't be too quick to just sign on renewal, especially with rates coming down to a point where you might actually have an easier time shopping. The other piece is that, we're starting to see the defined impacts of the renewal wall, which is that a lot of people are just renewing. This means that sellers might not be selling, right? Or they're maybe postponing Like that's a lot of supply that we're seeing that isn't getting listed on the MLS. I've always been of the opinion that the big thing of the renewal wall and the big risk of the renewal wall is that it actually introduces this huge flood of supply in 2027, because statistically, borrowers are most likely to sell their house when they're on a mortgage renewal. It's just the easiest time to do it, right? You don't have to pay a penalty. You try and get your closing date on the date your mortgage expires, etc. If we're seeing record number of renewals for big six banks, then this would tell me that more borrowers are deciding to stay put, which means that we might actually not see as big of a supply flood as I anticipated. I don't know. I think it really remains to be seen, and it's going to depend a lot on the economic setup and economic stress and sort of the way that a lot of these borrowers foresee their financial future in the next 365 days. But the renewal wall piece of the story isn't over, right? Banks are likely going to continue to compete on renewals. We might see more creative solutions. Regulators are obviously watching really closely too, and potentially getting rid of the OSFI stress test in Q1 of next year. So far, Canadians are coping very much with the help of the banks. I think banks have been given a lot of tools that they can use to make it easy for borrowers who are feeling financial stress. And that financial stress is creeping up. We're seeing rising delinquencies on credit cards and lines of credit, especially for those with mortgages. So if you're in the renewal boat soon, start budgeting for a higher rate now to avoid surprises. The swing back to fixed rates tells us that the market sentiment can change fast. And this is one of the interesting observations that I've seen from this chart that CMHC always puts out. Is I always just use this as a guidance of like, yeah, sure, people are probably always going to try and take the lower rate, but there also is an element of people trying to forecast what they think is going to happen to rates with the rate that they're choosing. Many who went variable a year ago did so expecting cuts to happen. Some have materialized, maybe some haven't. I don't know how much downside they would have priced into their variable rate path. And now some of those people are paying more than they would have if they'd maybe locked it. On the flip side, future borrowers might face the opposite scenario. If rates drop, variables could come back and vote. The lesson is obviously to assess your own risk tolerance. Right now, a lot of Canadians clearly prefer to lock in a midterm fixed rate, basically saying, I'll take a decent rate now and revisit in 3 years. They just want to get rid of the turbulence for that short-term period. One other very notable piece of information from the report is that borrowers are adjusting in other ways. A majority of new mortgages, uninsured, are opting for longer amortizations over 25 years, where the share of new uninsured mortgages at chartered banks with amortizations longer than 25 years remained above 60% in Q2 of 2025 for the fourth consecutive year. So basically, the vast majority of big six borrowers are taking 25 to 30 year amortizations of your uninsured borrowers. It means that people are taking longer to pay off their house. This means that they need to take that longer amortization. They need to pay less principal to be able to afford the mortgage payment, which means that people pay more debt over their lifetime, which isn't good for the economy. It's great for the banks. It's not good for the economy. And this is just another way that borrowers are coping with the high rate environment. And this is what this whole thing tells me is like, these are all coping mechanisms. That's number one is extend, reduce your payment. Number two is renew because you can't shop to another lender. It's just all something to be mindful of. If you extend your amortization on renewal, or if you're buying and to lower your payment, understand that you're paying a lot more interest over the life of that mortgage. I feel like so many people like haven't even done the math on this. Just go into a mortgage calculator. I'm just going to show you right now. $1 million mortgage, 5% interest rate, 25-year AM. Over the life of your mortgage, you pay $745,000 in interest on a 25 AM. If I go to 30, you're paying $921,000 in interest, $176,000 more interest just for extending your amortization by 5 years. What is that as a percent? 23% more interest just for a 5-year extension of your amortization, paying 23% more in interest. Anyway, to wrap this up, Canada's mortgage landscape in late 2025 is marked by a kind of cautious stability. Big six banks are reinforcing their dominance as Canadians weather this renewal storm largely in play. That stickiness of borrowers means banks aren't losing any customers at renewal. Indeed, they're optimizing their model for it and they're capitalizing on it. For consumers, it underscores the importance of being proactive at renewal time. There are savings to be had if you look, even if most people didn't. And it seems like most people aren't because they feel stuck in their mortgage product. They don't feel like they're going to go be able to qualify. And those are maybe the more important takeaways from my perspective is people are trapped in their mortgages. People are extending their amortizations on purchase and on renewal. Over 60% of mortgages have amortizations longer than 25 years of new uninsured mortgages. This isn't a healthy market. That's what I'm trying to tell you here. After the brief fling with variables that we had, we're back to the fixed mortgages being the most popular. The fact that you're 3 to 5 years, the most popular, tells me that people expect the current high rate cycle to maybe rates maybe not to come down as quickly in the short term, but they don't expect the higher for longer, and they don't think it'll last forever, but they're not confident enough to go short term on the variable just yet, which to me is really interesting. If that's what borrowers are communicating by switching away from variable, is that they're not seeing a ton more downside risk from the Bank of Canada on rates. And as a result of all of this, the big six banks are crushing it on renewals, which tells us that loyalty or inertia or momentum or whatever it is extremely strong in this market, something policymakers and challenger lenders will be looking at. Anyway, let me know. Statistically, a ton of you in my comments should have a mortgage coming up for renewal in the next year. I think it's it's a third of all mortgages next year come up for renewal. If you're going up for renewal, are you taking a variable? Are you taking a fixed? If you're taking a fixed, what duration of a fixed rate are you taking? Or are you selling, right? Are you going to renew? Are you going to shop it? Are you going to sell? What type of mortgage product are you going to take? Just curious to get your take. Let me know in the comments. And as always, thanks a lot for taking time to watch this video. It means a lot to me that you're taking time out of your day to do that. And I'll see you again as soon as I can.